Hello everyone, and welcome. I'm a real estate market analyst specializing in the U.S. housing sector. Over the past decade, I've had the privilege of studying the patterns, risks, and opportunities that shape this dynamic market. Today, I'd like to take you on a deep dive into the current state of U.S. real estate, and more importantly, where it might be heading in 2025. To set the stage, let's look back at the past few years. The U.S. housing market went through a roller coaster during and after the COVID-19 pandemic. We saw unprecedented demand fueled by low mortgage rates, government stimulus, and a shift toward remote work. Home prices skyrocketed, bidding wars became the norm, and inventory levels fell to historic lows. But as the Federal Reserve raised interest rates aggressively to combat inflation, the landscape shifted dramatically. Mortgage rates hit levels not seen in 2 decades, affordability plummeted, and both buyers and sellers pulled back. By late 2023 and into 2024, the market entered a period of stagnation. Sales volume dropped, new construction slowed, and many potential buyers remained sidelined. For sellers, the lock-in effect kept inventory tight, as homeowners with ultra-low mortgage rates were reluctant to move. Investors also became more cautious, weighing the risks of higher financing costs against long-term demand. Now, as we step into 2025, a crucial question emerges. Is this the turning point? Will the market break free from its current gridlock and enter a new cycle of growth? Or are we still facing prolonged uncertainty? There are signs pointing in both directions: shifts in interest rate policy, demographic forces, and evolving demand in different regions of the country. In this video, we'll explore those forces in detail, analyzing not just the risks but also the opportunities that could define the U.S. housing market in the year ahead. By the end, you'll have a clearer picture of where things stand and what it all means for investors, homeowners, and everyday buyers. U.S. Housing Market Overview 2025. As we step into 2025, the U.S. housing market presents a fascinating yet complex picture. Let's begin with the latest numbers. According to Redfin, the median home price nationwide now sits at around $443,000. This figure marks only a modest increase of about 1.2% year over year, a sharp contrast to the double-digit growth we witnessed during the pandemic boom. It signals that prices have stabilized, but they remain historically high compared to pre-2020 levels. On the financing side, there is a notable shift. Mortgage rates, after peaking above 7% in 2023, have eased to about 6.56%, their lowest point since 2024. While still far from the ultra-low rates of the pandemic era, this decline is significant. It offers some relief to potential buyers who had been priced out of the market, yet affordability challenges remain front and center. When you combine elevated prices with mortgage rates that are still roughly double what they were in 2020, it's clear why many households remain cautious. Now, let's talk about supply and demand. Inventory remains extremely tight. Many homeowners are effectively locked in by the low mortgage rates they secured in previous years. For them, selling a home would mean trading a 3% mortgage for a 6.5% one, an unattractive proposition. As a result, listings remain far below historical norms. On the demand side, buyers are hesitant. Some are waiting for further drops in interest rates, while others are simply priced out. This standoff between buyers and sellers has created what analysts often call a frozen market. The consequence is a situation where both sides are reluctant to act. Sellers hesitate to list, fearing they won't get the price they want or that they'll lose their current low-rate mortgage. Buyers hesitate to purchase, concerned about affordability and the possibility of future price corrections. The result? Transaction volumes are down, time on market is creeping upward, and the sense of momentum is missing. Looking ahead, many experts believe this gridlock could persist through 2025 and into 2026. The market is not collapsing, but it is also not moving forward at a normal pace. Without a significant change in interest rate policy, wage growth, or a sudden surge in new construction, we're likely to see more of the same: limited supply, cautious demand, and slow price growth. For investors and market watchers, this means 2 things. First, patience is key. Rapid appreciation is unlikely in the near term. Second, opportunities may still exist in specific markets where demographic shifts, job growth, or affordability advantages are creating localized demand. In other words, while the national picture looks stuck, the story can vary dramatically from one city to another. In summary, the U.S. housing market in 2025 is best described as stable but constrained. Prices are holding, rates have eased slightly, but the fundamental imbalance between supply and demand continues. Until that changes, the market will remain in a holding pattern, waiting, perhaps, for 2026 to bring a clearer direction. Emerging trends in the U.S. housing market 2025. While the overall market appears frozen, several powerful emerging trends are reshaping how and where Americans buy property. These trends reveal not only shifts in wealth and demographics, but also deep structural changes driven by climate, lifestyle, and investment strategies. Let's begin with the luxury segment. In places like Miami, Aspen, and Los Angeles, we're witnessing headline-grabbing transactions that seem detached from the mainstream housing slowdown. Ultra-high net worth buyers, many paying entirely in cash, are acquiring estates priced well above $50 million, with some properties even crossing the $300 million threshold. These deals highlight a clear divide. While middle-class buyers struggle with affordability, the luxury market continues to thrive, insulated from mortgage rates and driven by global wealth. Miami, in particular, has transformed into a magnet for international elites, thanks to its tax advantages, waterfront properties, and cultural vibrancy. Beyond luxury, we see a geographic shift in demand. For years, the Sun Belt, Florida, Texas, Arizona, was the epicenter of growth, fueled by population inflows, job creation, and relatively affordable housing. However, in 2025, affordability pressures and rising insurance costs in climate-vulnerable areas are pushing buyers to look elsewhere. Increasingly, attention is turning to the Rust Belt and Midwest, including states like Illinois, Pennsylvania, and Connecticut. These regions, long overlooked, now offer a combination of lower home prices, strong infrastructure, and growing appeal among remote workers and younger families seeking stability. What was once seen as flyover country is gradually becoming a new frontier for investors and homebuyers. Another striking development is the rise of off-grid and rural living. The pandemic reshaped lifestyle priorities, and that shift has only deepened. Many Americans are seeking self-sufficient, nature-oriented living far from urban centers. According to lending data, loans for rural and agricultural properties are up nearly 80% compared to pre-pandemic levels. This trend reflects not only a desire for space and affordability, but also a growing interest in sustainability. Solar-powered homes, private wells, and small-scale farming are increasingly attractive features. Investors are also taking note, as rural real estate becomes a long-term bet on alternative lifestyles and eco-conscious housing. Finally, no discussion of trends would be complete without addressing climate risk. Roughly 25% of U.S. homes, valued at an estimated $13 trillion, are classified as high risk for natural disasters, whether from hurricanes, floods, or wildfires. This reality is reshaping both buyer decisions and the insurance market. In states like Florida and California, insurance premiums have skyrocketed, in some cases doubling or tripling within a few years. For homeowners, this adds a hidden cost that can rival mortgage payments. For investors, it forces a recalibration. Properties in climate-resilient regions are becoming more desirable, while assets in vulnerable zones may lose long-term value. Together, these trends paint a picture of a fragmented housing market. Luxury thrives, rural living rises, new regions attract fresh demand, and climate challenges loom large. For buyers and investors alike, recognizing and adapting to these shifts will be critical for navigating the U.S. real estate landscape in 2025 and beyond. Segment analysis of the U.S. housing market 2025. To truly understand the U.S. housing market in 2025, we need to break it down by key segments. Each sector, mainstream housing, luxury, rental, and rural or green real estate, faces very different dynamics, challenges, and opportunities. Let's start with mainstream housing, the sector that affects the majority of American families. Despite a slowdown in price growth, affordability remains the biggest barrier. With median home prices still around $443,000 and mortgage rates above 6.5%, many middle-class households find ownership out of reach. Wages have not kept pace with rising housing costs, creating a widening gap between income and affordability. As a result, first-time buyers are delaying purchases, often renting longer or turning to smaller, less desirable properties. Builders, meanwhile, struggle with high land and labor costs, which makes it difficult to deliver truly affordable new homes. This segment is the most vulnerable to economic shifts, and until either prices adjust or wages rise significantly, mainstream housing will remain strained. Now, contrast this with the luxury housing market, which tells a completely different story. Here, demand is robust, insulated from interest rate movements because many buyers pay in cash. Cities like Miami, Los Angeles, and Aspen continue to see eye-popping sales, with some estates selling for $100 million or more. This segment is driven by global wealth flows, tax considerations, and lifestyle preferences rather than affordability metrics. For investors, luxury properties can serve as both safe havens for capital and as trophy assets. However, the market is not without risks. Regulatory scrutiny, climate exposure in coastal cities, and the limited pool of qualified buyers all create volatility. Still, compared to mainstream housing, luxury remains far more resilient in 2025. The rental and multifamily sector is another crucial area. With ownership costs high, demand for rentals is soaring. Millennials and Gen Z, who form the largest share of new household formations, increasingly find themselves priced out of homeownership. This fuels steady occupancy rates in urban apartments, suburban multifamily complexes, and even single-family rentals managed by institutional investors. Rent growth has moderated compared to the pandemic surge, but it remains positive, supported by limited supply. For investors, multifamily properties offer stable cash flow and resilience against market stagnation, making them one of the most attractive plays in 2025. Finally, we must consider rural land and green real estate. The off-grid movement, alongside growing emphasis on environmental, social, and governance (ESG) principles, has pushed this once niche sector into the spotlight. Rural housing demand has risen sharply. Financing activity is up nearly 80% compared to pre-pandemic levels. Buyers are seeking land for self-sufficiency, farming, or eco-friendly housing developments. Meanwhile, green-certified properties, featuring solar panels, energy-efficient systems, and sustainable materials, are commanding premium valuations. For investors with a long-term horizon, rural and ESG-aligned real estate represents both a financial opportunity and a hedge against future regulatory and climate risks. In short, the U.S. housing market is deeply segmented. Mainstream buyers remain squeezed, luxury thrives, rentals are in high demand, and rural/green housing offers long-term promise. Navigating these contrasts is essential for anyone hoping to succeed in real estate in 2025. Influential factors in the U.S. housing market 2025. To fully grasp the dynamics of the U.S. housing market in 2025, we must look beyond prices and sales data. Several external forces, ranging from central bank policy to global investment flows, are shaping both risks and opportunities. Let's examine the most important ones. The first and most critical is Federal Reserve policy and interest rates. After a period of aggressive rate hikes between 2022 and 2023 to combat inflation, the Fed has shifted to a more cautious stance. Mortgage rates, which peaked above 7%, have now eased to around 6.56%. Looking ahead, markets anticipate possible rate cuts in late 2025 or 2026, especially if inflation continues to trend downward and economic growth slows. Any such cuts could unlock pent-up demand, encouraging buyers who have been waiting on the sidelines. For now, however, the high-rate environment keeps affordability under pressure and limits mobility within the housing market. Next, we must consider the macroeconomic backdrop. Inflation has moderated compared to its 2022 highs, but households continue to feel the pinch from elevated living costs. Job markets remain strong, with unemployment low, yet wage growth has not kept pace with housing inflation over the past decade. Household incomes are improving modestly, but for many families, homeownership remains out of reach. If the labor market softens, or if a recession occurs, the housing sector could face additional stress. Conversely, stable employment and gradual wage growth could support steady, though not spectacular, housing demand. Another factor gaining urgency is insurance costs and climate risk. In states like Florida and California, homeowners face skyrocketing insurance premiums due to hurricanes, flooding, and wildfires. In some areas, insurers have even withdrawn from the market entirely, leaving residents with limited coverage options. These rising costs significantly impact affordability and are increasingly factored into buyer decisions. A property that looks attractive on paper may become far less desirable once the true cost of insurance is included. Over time, this dynamic could shift demand toward more climate-resilient regions, while vulnerable markets risk stagnation or even decline in property values. Finally, we cannot overlook the role of foreign investment. International buyers from China, Canada, and Europe remain influential in shaping U.S. real estate, particularly in luxury markets like New York, Miami, and Los Angeles. For many, American property serves as both a safe haven asset and a lifestyle investment. While foreign investment slowed during the pandemic due to travel restrictions, it has rebounded in recent years. In 2025, we are seeing renewed interest from overseas investors seeking diversification, stability, and dollar-denominated assets. This inflow adds liquidity to certain markets, but can also intensify affordability pressures for local buyers. In summary, the U.S. housing market in 2025 is being pulled in multiple directions by Fed policy, economic fundamentals, climate-related costs, and global capital flows. These factors interact in complex ways, creating both headwinds and tailwinds. For investors and homebuyers alike, success will depend on not only understanding property-level fundamentals, but also keeping a close eye on these larger forces shaping the future of real estate. Opportunities and risks for real estate investors in 2025. For investors navigating the U.S. housing market in 2025, the environment is filled with both promising opportunities and significant risks. Understanding where growth potential lies and where caution is necessary will determine who thrives and who struggles in the coming years. Let's begin with the opportunities. One of the most compelling is the shift toward the Rust Belt and Midwest. Cities in states like Illinois, Ohio, Pennsylvania, and Michigan are experiencing renewed interest due to their relative affordability and improving economic fundamentals. Unlike overheated coastal and Sun Belt markets, these regions offer lower entry costs, strong rental yields, and the potential for long-term appreciation as remote work and demographic shifts make them more attractive. For investors willing to look beyond the traditional hotspots, the Midwest represents a chance to buy undervalued assets before broader demand takes hold. A second opportunity lies in the rental and multifamily sector. With mortgage rates still high and homeownership out of reach for many, demand for rentals remains robust. Multifamily properties, from suburban apartment complexes to urban mid-rises, continue to post strong occupancy rates. Even single-family rentals, managed by institutional investors, are proving resilient. For investors, this segment provides stable cash flow, diversification, and protection against a stagnant sales market. In 2025, multifamily is widely considered one of the safest bets in real estate. Third, we see growing potential in rural and green real estate. The off-grid movement, alongside consumer demand for eco-friendly housing, is driving interest in rural properties and sustainable developments. Vacation homes, farm-style estates, and green-certified housing are attracting both lifestyle buyers and forward-thinking investors. With lending for rural properties up nearly 80% since pre-pandemic levels, this niche is no longer fringe. It is becoming a legitimate growth segment. For those with a long-term horizon, investing in rural and ESG-aligned real estate offers both profitability and resilience. However, with every opportunity comes risk. Perhaps the most pressing is exposure to climate-vulnerable regions. Properties in Florida, California, and coastal Texas face mounting insurance costs, physical damage risks, and long-term devaluation. Investors who ignore climate resilience may find themselves holding assets that are difficult to insure, sell, or rent at competitive rates. Another risk is the possibility of price bubbles in overheated markets. Cities like Miami and Phoenix have seen extraordinary growth, fueled by luxury demand and rapid in-migration. While momentum is still strong, valuations are stretched, and any downturn in the broader economy could trigger corrections. For investors, chasing short-term gains in these hot zones carries real danger. Finally, the biggest overarching risk is the frozen nature of the housing market itself. With low supply, high mortgage rates, and hesitant buyers, transaction volumes remain depressed. Many analysts believe the market will stay sluggish until at least 2026, when meaningful Fed rate cuts could reignite activity. For investors, this means patience is essential. Capital may be tied up longer than expected before generating strong returns. In conclusion, 2025 offers investors a dual reality: rich opportunities in overlooked regions, rental housing, and sustainable development, but also serious risks in climate-exposed areas, overheated markets, and a sluggish national landscape. Strategic selection, careful risk management, and long-term thinking will separate the winners from the rest. Conclusion and forecast. As we wrap up this deep dive into the U.S. housing market, one thing becomes clear: 2025 is a transitional year, not a breakout year. The market is neither collapsing nor booming. Instead, it sits at a delicate crossroads, stabilized by limited supply, yet restrained by affordability challenges and elevated interest rates. For homebuyers, the message is one of patience and selectivity. Affordability remains stretched, and while mortgage rates have eased slightly, they are still far from the historically low levels that drove the pandemic boom. Jumping into the market without careful consideration could mean overpaying or locking into a mortgage that strains household budgets. Buyers who wait for the right conditions, whether that means more favorable interest rates, wage improvements, or simply better local opportunities, will be better positioned for long-term stability. For investors, the path forward lies in focusing on sustainable and resilient segments. Rental housing, particularly multifamily, continues to offer steady demand and cash flow, making it a reliable cornerstone in uncertain times. Similarly, overlooked markets in the Rust Belt and Midwest present real opportunities to acquire undervalued assets before broader attention drives prices higher. Rural and green properties also stand out as future-proof investments, aligning with lifestyle trends and climate-conscious demand. In 2025, these areas provide the most compelling balance of stability and growth potential. At the same time, caution is critical. Overheated markets like Miami and Phoenix carry bubble-like characteristics, while climate-exposed regions face long-term risks from rising insurance costs and physical vulnerability. Investors who ignore these realities may see short-term gains erode into long-term liabilities. Strategic risk management, evaluating not just the asset but also the broader environmental and macroeconomic context, will be essential. Looking forward, much hinges on the Federal Reserve's policy path. If the Fed proceeds with meaningful interest rate cuts in late 2025 or into 2026, the market could finally break free from its current gridlock. Lower borrowing costs would release pent-up demand, encourage sellers to re-enter the market, and potentially spark the next upward cycle in housing. In other words, 2026 may be the year the housing market truly rebounds, provided monetary conditions align. Until then, the story of 2025 is one of transition and preparation. Buyers should watch carefully, investors should position themselves strategically, and all market participants should recognize that the strongest opportunities will reward patience, discipline, and foresight. In summary, 2025 is not the year of explosive growth, but rather the year to lay the groundwork for success in 2026 and beyond. For those who adapt wisely, the coming cycle could be one of the most rewarding in recent memory.